capital efficiency determines what is the return I will get on the capital that I've deployed for trading. In simple terms, it is maximizing the return on the opportunity cost of our capital without changing the risk profile. In other words, maximizing the return on our capital in time dimension. What do we mean by this? Let's say I have three different trades. So over the next 10 days, which of these three trades will give me the highest return for the same risk? Let's take an example here. Let's say you sell a put option of a stock ABC at a strike price of 100 and collect a premium of 10 bucks. After a few days, the premium declines and this put option is now trading at 5 bucks. Now, at this point of time, your maximum profit potential, which is outstanding, is half of what it was when you entered the trade, but your risk remains the same. So you sold this option at 10 bucks per share and now it is trading at 5 bucks. So you've already extracted 50% of your maximum profit potential in this trade. So a good decision at this point is to exit this trade and deploy this capital in another trade where the absolute return on capital is greater for the same risk for the same duration. So let's say at this point of time, the additional profit that I can make from this trade is only 5 bucks. Whereas there is another trade which requires the same amount of capital to be deployed and where the risk again is undefined and the probability of going wrong is equal to the probability of going wrong in this trade, but I can get a premium of 10 bucks. So it makes sense for me to book my profit here, take my 5 bucks off the table, and redeploy this capital in another trade where I can earn 10 bucks all over again. So this way I'm maximizing the opportunity cost of the capital that I have deployed for this trade. Another way to do this is by rolling up the strike price of our existing trade. So we sold this put option originally at a strike price of 100 bucks. We've extracted about 50% juice out of the premium that we initially sold it for. So we can now roll it up, we can square off the current option and we can sell another put option at a strike price of 110 or maybe 120 depending on where the current spot is and extract a higher premium. So this is another way that we can maximize the return on the capital that we deployed for this trade. Okay, let's take another example and this time we'll take the example of a strangle. So let's say you sell a strangle of a stock XYZ at a strike price of 20, that is on the lower side, which is the short put option, and 50 on the higher side, which is the call option. And you collect a premium of 5 bucks on each of the legs, so you collect a total premium of 10 bucks. And the spot price is right now right in between at 35. So in this triangle, you sold a put option at a strike of 20 and you sold a call option at a strike of 50. Now, after a few days, let's say the spot price moves up to 45 and now your put option is trading at 2 bucks, whereas the call option is trading at 8. So since the price has moved up, this trade has already extracted about 60% of the potential maximum profit on the put side. And so we should move the strike of our put option higher to let's say 40 and collect a higher premium of 5 again, just like we did in the previous example. Now by doing this, we are adding more premium on the put side and thereby ensuring a higher return on capital deployed for the put part of this trade. And also by doing so, we are extending the break-even price on the higher side since the price is now trending upwards. And by doing this, we also end up increasing the potential returns of our total capital deployed in this trade and also shift our trading range higher in line with price move. So since the price is trending upwards, our call option is now threatened. And by rolling up the strike price of put option and collecting a higher premium, we extend the break-even range on the higher side. So this way we are also doing a risk management and also increasing the capital efficiency of our overall strangle. So that's on capital efficiency. It's a very, very important concept. The market is a living organism. Your trade is a living organism, and you need to keep on managing your trade to ensure that you're getting the maximum possible return on the capital which is outstanding in the market. Okay, In the next video, we'll talk about an important consideration for constructing a portfolio.